Hey guys, welcome back to the channel and happy Easter for all that celebrate. Today's video, I want to dive into an article that I read this morning that I think is really interesting. And I think it focuses on the point that we hear in the marketplace right now. There are a ton of people that are talking about how the AI trade is getting too crowded, how we are moving out of the hype phase and we're entering into a phase that is all about real numbers, financials. How are we monetizing AI? So the article I came across this morning that I'll pull up right now dives into that topic perfectly. And this is the thing I want to discuss. I'm going to give you my thoughts and commentary on it, but I would love to hear your comments below. Drop a comment after the video. Tell me what you think, how you're feeling. Let's engage across the community. Let's have a debate about this topic overall. And also, I'd love to see you do, if you haven't done it yet, is hit like or subscribe to the channel. For all of you that have subscribed already, thank you. For those that haven't yet, do it now. I want you to be part of the community. I want to be able to engage with each and every one of you and share some of the insights like we're going to do today. So the article you see, it was on Bar Chart and it posts AI stocks are exiting an era of blind faith and we're entering a year of strict numbers. What investors need to know and what they need to watch for this earnings season. And the article on the surface is absolutely right. I think you feel it. The market is moving away from blindly investing or blindly picking any AI stock. And we're being more selective. We want to see what are the real numbers, the real margins, the real returns that are associated with AI. That feels like a safer play for our dollars right now overall. But I think the piece that is missing, what the author is missing when he published it, is he's mentioning that this is a shift that's going to happen. Guys, I think this shift has already happened. I think each and every one of us probably feel that and have seen it. We definitely have seen it just in the trading sessions past week, but we have seen this shift probably all of 2026. Maybe some of us have seen it even before. Because at the heart, I think when you slow down and look at it, we have to admit this is not an AI trade that is slowing down at all. But I think you could make the argument that this is an AI trade that is starting to split apart. We're starting to see winners from laggards. We're starting to see capital rotate into different stocks, into different companies right now. And that's what I want to dive into. And I want to talk more about today's video and share a little more from the article overall, because I think the core argument or the thesis from the article is simple. We're moving away from blindly buying AI based on just kind of vision and hope to actually evaluating AI based on financial performance, hard data, facts, results. And if I pull the article back up, you can see the author does dive into that. And there's some key pieces I want to lay the groundwork, the foundation for here before we dive any further. You can see in the beginning, it's impossible to ignore, he says, the sentiment shift in Wall Street this year. That in the past with AI rallies, it was driven by hope, visionaryism, promises of the upcoming tech revolution, and investors essentially bought everything. They gave blank checks. But this is starting to change. He mentions that we're starting to see a more stricter environment. And you can see below here this line that we're transitioning from a phase of unconditional faith in the magic of AI to a phase of demands for real cash flow. And the other piece that I really agreed with, and you guys let me know below in the comments if you feel this too, but he mentions in these types of transitional moments that we find ourselves right now in AI, that the information field, and maybe even us as investors often get polarized. And because we can succumb to this cognitive distortions or the arguments that we hear, and we get confused and we get polarized, is a better way to say it. So he mentions in the middle paragraph that we're moving from a phase or a market that bought everything associated with AI. And now we hear so many voices are skeptics. There's so many skeptical voices now that are talking about AI as the next inflated bubble that's about to burst, and it's creating fear and anxiety in the market. And he goes on to say that, jumping from this one extreme to the other is the worst possible strategy you can have as an investor. And I agree. I think we always have to have a long-term view. We have to remember the reason we selected the companies, and we have to block out as much of the noise and really look at the true signals that we can. Because he goes to say that the truth always lies somewhere in the middle. There is no catastrophic or dramatic collapse of AI that is occurring in the market. The technology works, it implements itself, it bears fruit, he goes to say. But he says today what we're observing is not a crash of illusions, but a absolutely logical, healthy process of a maturing market. We're moving, the valuation of tech companies is evolving. Essentially, its emotional capital yields is taking its place now. That's taking place for mathematical calculations as a whole. And so I think that kind of rung true for me. I'd love to hear your thoughts as well, because I see it a bit. I mean, we've seen there's definitely a desire to want to see how we are monetizing this. And this was all, I think, when all the Magnificent Seven gave their earnings and they saw the level of capex, that's what suppressed those stocks. I mean, I think people were worried that we are just overspending on capex, driving more and more investment into AI without seeing a return of it yet. The author does call out Google as a company that is a great example of one that is winning right now, that is being able to show monetization, because they had 132 billion in net income and a 24x in forward PE. And he says, for a company like Google, they simply just don't invest in AI. They find a way to successfully incorporate it into its entire ecosystem. They're raising the return of AI from everything from capital to cloud services. So he says this is a great example of a company that was issued an early vote of confidence around AI, and now they're finding ways to prove that and monetizing that investment overall. And so I think the article, and what I agree with is in general, is that we as investors are looking to see proof or real sources of AI monetization. I agree with that. But I think what the article is missing is something important. This isn't a future shift in investment strategy or investment sentiment. This shift is happening right now in real time. I know I felt it last week, particularly when you look at the memory companies, but when you look at the tech stocks in general, we felt it last week. Because just see how those stocks were traded. The market didn't sell tech, didn't sell memory blindly across the board last week. It was much more selective. It was rotating capital selectively, finicky, as I mentioned earlier, if you remember. So that's what we saw. It was a bit of more of a choosing within the AI trade. There was definitely some choosing within the memory trade, what we saw last week. And this is where the article's thesis becomes, I think, real life, when we start to really see how it showed up in the market this past week. You had a ton of pressure on tech stocks and memory stocks going into last week. We saw rates moving, oil prices rising, macro pressure in general. The environment was really high. But if we look at the memory trade, the behavior, the action in the memory trade wasn't uniform last week. We saw Micron was much more volatile than the rest of the group. It was questioned much more than the other three in the Fab Four. Western Digital saw selling pressure throughout the week, but we saw Seagate and SanDisk operate differently. They held up and they actually moved higher throughout the entire week. And so if this was a broad AI slowdown, if this was a broad slowdown across the board, you wouldn't see that. You wouldn't see capital rotating selectively like that. You would see it kind of rotating completely out of the sector. So the point that the article is trying to make, I think it's not fully proved when you look at that. You can't prove that when you look at the action we saw this past week. And another area where I just want to push back a little bit on the author and his narrative overall, because when people see and read this type of article, they're going to take away there's going to be one takeaway. It's going to be very clear for them. They're going to think that the AI demand is slowing down, that investors are moving out of it, that we're going to see a slowdown overall. And I think the real world data is telling us something completely different. If anything, right now, in my belief, demand is actually accelerating. It's not slowing. You're still seeing continued hyperscaler spending. You're seeing enterprise adoption is continuing to expand across the board. And we're seeing infrastructure that is still scaling. That's not signs of anything that is slowing. So if the demand was the issue, if demand isn't the issue, then the author goes on to say what he thinks it is. And it's an interesting argument. He thinks it's efficiency and cost, because he starts to talk a bit more about the market moving towards energy and efficiency, cost optimization, ASICs versus GPUs. And let me show you that piece in the article too. You can see it's like the reevaluation will not only touch software giants, but also hardware infrastructure. He says the first years of AI boom demanded raw universal computing power for the training of tech-based models, training of giant-based models. This was a period of total domination by the pioneers in the GPU market. So think NVIDIA, think AMD. But by the measure of how the industry transitions from a stage of training two, of application or inference, the economies of computing come to the forefront. Energy efficiency and lowering the cost per request. That is the big focus now overall, as the author goes on to mention. And in theory, I've said he's not wrong. I think what a clearer way to think about this, in my opinion, is the market is shifting to cost per AI output. Not who has the biggest model, not who spends the most, but who can deliver AI the cheapest at scale. And when that becomes the focus, the real winners start to emerge. The real winners start to change potentially in the market. So if we bring this back to memory, the article talks about infrastructure broadly, but it doesn't go deep enough into where the true bottlenecks are within that infrastructure, within the AI demand, because AI does not scale without memory. It does not get cheaper without a memory efficient. So now the market is asking, which companies can actually capture this shift? And that's what you're seeing. That's the divergence you're seeing, because go back, Micron, it's still tied to such high AI expectations. It makes it more volatile because the expectations and the evaluations in the companies are so high. Seagate has steady demand, steady earnings, cash flow, so the market sees them as more stable. SanDisk is benefiting from the NAND normalization, the explosive growth, the explosive demand we see there. So companies are rewarding that right now. And then Western Digital has strong execution, but it still has some restructuring uncertainty right now. That's the way the market is looking at it, and it's causing increased pressure overall in the stock in that company. This is not random. This is the market assigning a value of who converts demand into profit. And I'll go a step further than the author points out in his article. He frames this as this is the end of easy investing in AI. I don't think that's right. I think what this actually is the end of lazy investing in AI. I think that investment strategy where you just buy anything and hope for the best and a bit of more of a lazy approach to the market, that is over. It's a big difference, because what happens next is not slower growth. It's more concentrated growth. And historically, when the market shifts to more concentrated growth, that's where the real biggest winners and the real winners start to emerge. They start to appear. And here's what the author had to say in his conclusion overall, because I think this is an important piece to point out. And he says that it's important to emphasize again, in this process, there is nothing catastrophic. The market is not collapsing. It is simply changing in an absolutely healthy, rational direction. And for a thoughtful investor, so moving away from that lazy investor, as I mentioned, for a thoughtful investor, this new strict reality opens excellent opportunities for the purchase of really strong businesses at adequate prices. That's exactly what we're seeing in the market right now. It's exactly what we've talked about on this channel. So if you step back and connect all of this, here's what I believe the market actually figured out over the last few training sessions, starting to figure out this year. Demand is real. Spending is real. AI is not slowing. But not everyone wins equally anymore. That's the biggest shift, because now multiple expansions become selective. Capital becomes more disciplined. And the article mentions, and I agree with, the golden era of stock picking matters so much more again. So in the way I'm thinking about it overall, and the way I thought about this article is very simple. The market didn't change its mind on AI. It changed its mind, or it's starting to change its mind on how it values it. And you can see it in the price action. Some names are getting questioned, some are getting rewarded, and the gap is starting to widen between those companies that are being questioned and rewarded. So going into the earnings session, the question is not, is AI strong? Is AI demand still big? The question is, who's actually proving it in the numbers, in the financial data, in the real outcomes? Because those are the stocks that are going to get rewarded. Those are the stocks that are going to lead the pack right now. And ultimately, guys, those are the stocks that we as investors need to find and start to move our own personal capital into to get rewarded the most as we move forward. So anyways, let me know your thoughts and comments below. I hope you have a great Easter for those that celebrate. For others, have a great weekend, and I look forward to seeing you soon. Take care.